Hi everyone, I'm Joe here, and in this video I'm going over the investment strategy that is recommended by one of the most successful investors of all time, and his name is Warren Buffett. And when you hear his name, some of you might have a clue of what the investment strategy is. And anyway, I'm gonna mention it right now, and that is investing in index funds. By the end of this video, you will take away what index funds are, their pros and cons, and how you can invest in them in your portfolio. So make sure you stay until the end of this video, and also click like and subscribe my channel because I'm dropping more value content just like this. Now let's get started. Warren Buffett recommends investors to invest in index funds, buy and hold them for long term because it is very simple and very effective. It's like the repeated cycle of buy and hold, buy more and wait, buy more, hold, buy more. Simple, right? He also states that index funds are a haven for savings for the later years in life. Rather than picking individual stocks for investment, he claims that it makes more sense for an average investor to buy all of S&P 500 companies at the low cost. If one of the most successful investors of all time recommends index funds, shouldn't the average investor pay attention to what he is saying? And guess what? Here is the good news. You can implement this strategy now in 2022 and beyond. Before I mention index fund investing, let's go over what an index fund is. An index fund is a bundle of stocks in a fund to track the performance of the financial market index. Think of it as different types of fruits in a basket. Some of the most popular index funds are S&P 500, Dow Jones Industrial Average, and the Nasdaq. Now let's take a look at S&P 500 index as an example, and that represents the largest 500 companies in the United States. Owning a share of S&P 500 index would mean that you are indirectly owning those 500 companies in your portfolio. And those companies include Google, Apple, Facebook, Chase, Tesla, and the list goes on. The performance of S&P 500 index has been going through an upward trend over the last 40 years with major economic downturn due to the Great Depression, dot-com boom, housing crash, and the pandemic, just to name a few. But you cannot just go buy S&P 500 index on any brokerage accounts because it's not available. But what you can do is you can buy ETFs, known as exchange traded funds, or the mutual funds that match the performance of S&P 500 index. When you buy an ETF or a mutual fund that matches the performance of S&P 500 index, then you will be getting almost the same ROI in your portfolio, just like the performance of the index fund, which is in this case S&P 500 index. So for example, the S&P 500 index is returning 10% in 2022, then the ETF or the mutual fund that you invest in will also be closer to 10% ROI in your portfolio. Here are some benefits of investing in index funds, and number one, that is lower risk. By investing in an index fund, you are more diversified than owning an individual stock. If you were to own an individual stock, and knock on wood, that stock that you chose drops like 40% because the CEO of the company posts some erratic posts on Twitter. And at that time, since you have only selected an individual stock in your portfolio and that stock drops 40%, your entire portfolio drops 40% as well. And to add fuel to the fire, the chances of an individual company going bankrupt might be quite high. With an index fund, you have more exposure to the stock market. And when you buy ETFs or mutual funds that track the performance of S&P 500 index, you are more diversified than owning some individual stocks. Because you are owning over hundreds of stocks, then the risk goes down. Even when some stocks are not doing well in a particular year, then there are other stocks that will be beating earnings record and making profits as years goes by. So owning an index fund gives you peace of mind. The second benefit of owning an index fund will be lower costs. Index funds have lower fees than the actively managed funds, and those two funds are entirely different in various aspects. The reason is that the fund managers of the index funds are not actively buying and selling stocks and timing the market. For actively managed funds, having to pay for those advisors, fund managers, transaction fees, and all other fees drive up the cost of owning actively managed funds. And who pays for those fees? Sadly, the investors. The investors who invest in those actively managed funds. And that is why the investors who invest in those actively managed funds have lower return at the end of the year, because some of the profits are being shared to those fund managers. The expense ratio, or the cost of owning those ETF and mutual funds, are just shy of 0.04%. Can you imagine? That means for every $10,000 that you invest, you are only paying $4 for the management fees when you buy index funds. So that means there is more money coming to your wallet compared to investing in actively managed funds. And the third benefit would be no need to track an individual company's earnings and performance. I know this is a great benefit, right? Because most of us are very busy with the full-time job and personal life, and it is quite challenging for us to be tracking individual companies on their earnings report and their performance every quarter. When you are investing in index funds, you are owning hundreds of stocks in your portfolio. When some companies are not doing well in any quarter, you do not have to worry about it, because there are some other companies that are beating earnings report. In other words, they are creating more profit every quarter. So that means you are offsetting the loss and the risk in your portfolio. Investing in index funds gives you peace of mind, and you can literally set it and forget it. But in this case, you can buy it and forget it. And the fourth benefit would be the long-term growth. If you're investing with the long-term growth in mind, then investing in index fund can be one of the best ways to go. Over the past 40 years, the S&P 500 has been growing tremendously and providing positive returns. This is because US economy is booming due to an increase in population, which drives up the consumer demand, which indirectly drives up the company's profits. According to some stats, S&P 500 has been averaging about 7% return on investment with adjusted to inflation. That means investing in that S&P 500 index fund, your money is growing 7% compounded every single year. With that being said, your money is growing by itself, and it is creating more money as years pass by. Albert Einstein describes compound interest as the eighth wonder of the world. He who understands it earns it, and he who doesn't pays for it. While your money invested in index funds keeps growing, you can also contribute more money on a weekly or monthly basis to multiply your wealth. And in that case, not only your initial investment keeps growing, your additional investment, your additional contribution also keeps growing at 7% as well. So that's how you can multiply your wealth. That's the strategy how the rich becomes richer, because they know how to use compound interest to their advantage. By the way, what I mentioned a while ago about contributing on a monthly or weekly basis, that is the strategy of dollar cost averaging. That means you are buying into the stock market when the market is high and also the market is low. In that way, that averages out the average cost of the index funds. The dollar cost averaging is an effective strategy, and it will help you attain compound growth in your portfolio when the market keeps reaching to new highs. Now you're familiar with the benefits of investing in index funds, but if I don't mention about the downsides of investing in index funds, then you might think I'm so biased towards it. That's why I'm sharing you the downside of investing in index funds. Now that you have it. Investing in index funds gives you lower return overall compared to the growth stocks that have the potential to grow like 50% or 100% or even 1,000%. By investing in index funds, you will be missing out on bullish runs of those growth stocks such as Amazon, Netflix, Tesla, Nvidia, and the list goes on, especially when they beat their earnings report and reach to new highs. And another downside of investing in index funds is that you do not have the control on how much percentage you want to own for each individual stock. Let's say you want to own 50% of your portfolio on Apple stock. You cannot do that while you are investing in index funds. But you can buy $500 worth of Apple stock when you have a $1,000 portfolio and when you choose to invest in individual stocks. The reason is that when you buy index funds, you are buying into the stock bundle that the index fund offers. So you have no choice on how much percentage you want to own for each individual stock. But overall, there are more benefits than the downsides when it comes to investing in index funds. I would definitely recommend you to do more research on investing in index funds versus investing in individual stocks, and then you can decide which strategy would work for you. Now, after hearing about the pros and cons of investing in index funds, if you're interested, I am going to mention about how you can invest in index funds. Are you excited? Here is an example of an ETF that tracks the performance of S&P 500 index. The ticker symbol is VOO, and it is currently priced at around $402 at the time of making this video. VOO ETF tracks the performance of S&P 500 index, and therefore by owning it, you will be indirectly owning 500 largest companies in certain percentages described in VOO ETF. With an expense ratio that low in the industry, it brings more money to your wallet than money going towards fund manager and for their fees. And fortunately, VOO ETF is available on almost any brokerages in the United States. You can buy a share or shares of VOO on Robinhood, Webull, Fidelity, E-Trade, and all other available brokerages in the United States. Therefore, you have so many options out there. Currently, I'm using Fidelity, Robinhood, Webull, and Vanguard. And here's my investment on VOO. It has been returning decent amount in profits, and I am planning to hold it for long term. So either I'm holding it or I'm buying more, but I'm not going to sell it. If you are a beginner in stock market investing and have not signed up any brokerages, you can get started with Robinhood or Webull because you will be getting free stock using my link below in the description. In my opinion, those two platforms are beginner friendly. That's a wrap for now. I hope you find this content valuable. If that's the case, drop a like down below and also subscribe my channel and click the notification bell so that you can get notified when I upload new videos just like this. I make content on personal finance, investing, entrepreneurship, and lifestyle videos. So if you don't want to miss out, you should definitely subscribe my channel. And Thank you so much for watching, and I'll see you in the next video.